All right, everybody. Today is Friday, March the 14th, 2025. Happy Pi Day. And it has been a rough start to the month of March here for U.S. equities. And so today, Chad and I are getting on. We're just going to talk about this idea about whether or not the bull market is over or if it is just beginning, because the answer is probably going to depend on where you're looking. Um,
Mhm.
and so just to kind of set the stage, let's flash over here and we see that month to date that the Dow Jones Industrial Average, despite being up today by a little better than 1.33%, is down over 5.5% for the month. The S&P is down over 5.5% for the month. The Nasdaq down over 6. Russell 2000 down about 5.75. Now, we do see that whether you have growth or value stocks, they're both in the hole for the year. However, value stocks year to date are basically flat, where the growth stocks that have really dominated over the last couple years are down over 8% this year. But outside of the U.S. market, international stocks are actually positive month to date, up over 8% for the year. Emerging markets, positive month to date, up close to 3% for the year. And commodities are positive month to date, up almost 6% year to date. And so, Chad, it is the elements of the portfolio, the diversifiers in the portfolio, that are actually carrying the water for investors so far this year.
Yeah, absolutely. And it's long overdue, right? We've been talking about for a while with the extremes that have developed in the markets, in particular the over concentration in these large cap growth U.S. stocks that dominate the main indices like the S&P and the Nasdaq. How everybody has really piled into those areas of the market and they've led the charge, and that's been good for folks that have been exposed to those areas, but it's also been fraught with risk because the extremes that we've gotten to were very alarming because we were rivaling other extreme high overvaluation and overconcentration and relative outperformance levels of previous market peaks historically. And what we've been talking about is the fact that we need to be aware of this and understand that that makes the market vulnerable to corrections or pullbacks. The other thing, and so we're beginning to see that now. The other thing that's been unique about the environment and the markets over the last few years has been this kind of idea that there's been a bear market in diversification, right, Stephen?
Sure.
And people have been ignoring the merits of diversification, thinking about other asset classes, other areas of the equity market landscape globally, and just forsaking that for focusing more and exclusively on the U.S. large cap growth stocks. And so that kind of unwinding of that now and a rotation that's begun out of these large cap, mega cap stocks in the U.S. and into these other areas is to be expected and is reasonable, right?
Yeah, and so, just to kind of set the stage for where we are right now, the S&P 500 as a proxy for large cap US stocks, but very dominated by these big names, these big tech names, that's been in an uptrend for since late 2023. But we're seeing now that the trajectory of the S&P 500 is now not higher anymore. It's now starting to move lower. And we juxtapose that against areas like the international markets, and we see that the trend for those markets, it's not lower. It's not rolling over and moving down. It's still in an uptrend. And we kind of saw that with the year-to-date performance, with the month-to-date performance. We covered this topic in our monthly client review, but it was this idea that where this level of outperformance is coming from for the international markets, it's coming from a place where the valuations for international stocks are about as low as they've ever been relative to the US.
Mm-hmm.
And they've underperformed the US market so badly over the last 15 years. And, to your point, where there's been this bear market in diversification, well, people have been driven away from being exposed to international markets for the last 8, 10, 15 years because they've underperformed the US market fairly dramatically. So over the
Mm-hmm.
last 15 years, the S&P 500's annualized at 14%, where Europe, Japan, emerging markets, China have had a fraction of the performance. But what we've been speaking about is that should we be surprised at the extent of the underperformance from these international markets, given that 15 years ago, coming out of the financial crisis, we saw international stocks relative to the U.S. They were as expensive
Mm-hmm.
as they've ever been, and
Right.
so from that level of relative overvaluation came 15 years worth of dramatic underperformance. But now we find ourselves at a place where the international markets are substantially undervalued relative to the US, meaning the S&P is very expensive on a relative basis. So
Right.
looking forward, should we be surprised if we saw the shoe on the other foot, where if we saw this chart 15 years from now and we saw that the S&P was down here, but international and emerging markets were up here, should we be surprised about that?
Right.
I,
No.
I'm going to say no, because in the long run, valuations matter. Starting valuations matter to long-term results. And so we're starting to see an unwind there.
Yeah.
When we
And
look at it on a relative basis here, right? Let's look at the S&P relative to developed international stocks on a relative basis, and we see that the trend there has certainly rolled over. We've gotten extremely extended over the last 15, 17 years of US
Mhm.
outperformance. But it cannot last forever, and it is now rolling over in favor of those international markets.
Right. And what's interesting is, that is that leads to this question about, what's driving the changes in the markets today. And we've been talking recently about how it's almost comical that investors at large, but especially the media, are quick to want to assign blame or assign causality to what's driving the markets. And of course, right now, with the U.S. market pulling back, and there's been a lot of volatility and volatility to the downside in the U.S. stocks, especially, it's coincided with so much chatter around the Trump tariff policy. And it obviously, we think we all know that it's been changing almost daily in the administration, saying they're going to impose this tariff and then maybe pulling it back, and then maybe we're going to do a counter tariff, and back and forth we go. And seemingly that has been a culprit for causing this downside volatility and anxiety in the markets. And while that may be true, it's not necessarily the exclusive reason. And what we know is that when the extremes get to this point, the extremes in overvaluation, extremes in over ownership and over concentration, the market is vulnerable to to a pullback, and any number of things could cause that. And so what has been interesting about that, what you just highlighted, the undervaluation of international equities, the extreme under ownership of international equities by investors all over the world. And that sets the stage for, in the face of all the tariff chatter, one might otherwise expect to not see international stocks do well, but the opposite has happened, right?
Yeah, and so the fact that the media is trying to point to tariffs as being the cause, the culprit of this market volatility, it's really the excuse. But where it doesn't jive is the fact that you would think that these international companies would be hurt by it more, but
Yep.
they're actually doing better than the US market. Uh, and so, again, we don't really buy this narrative that it's the tariffs that are causing the market volatility. Maybe it's the excuse du jour,
Right.
but the the circumstances coming into this environment, into the
Hmm.
beginning of the Trump administration, is that US equities were very expensive on from a valuation perspective, overextended on a relative basis compared to international markets, really compared to everything. When we look
Yeah.
at, we talked about the performance of commodities as being one of the better performing asset classes this year. When we look at the US market, the S&P relative to commodities, we see kind of a similar picture here. I want to set this up looking at it in a similar fashion to the way that we like to gauge things. Um, but we see that the trajectory here now for uh, US stocks relative to the CRB index is
Yep.
now pointed lower. It's now
Hmm.
moving down. Substantial outperformance from US stocks relative to commodities for 15 year or for 12 years or so, from the lows in 2008 up to where they peaked out in early 2020 going into COVID. Oil
Yep.
prices were crashing. Um, but we're starting to see the S&P 500, which has been the dominant investment category for many years, it is starting to underperform other areas. It's not just the international stocks, it's not just the
Right.
emerging market stocks, it's also the commodities. And so, again, I don't think we should be surprised that it's happening, given that we're beginning now with excess valuations, and most investors are probably poorly positioned for where the market is likely headed over
Sure.
the next 5, 10, 15 years. As you mentioned, there has been a rise in a bear market in diversification. Most people have forsaken these other areas because of their lack of accretive performance to their portfolio. And when they need them the most, right now, so far in 2025, they're probably way underexposed.
Yeah. Well, and that also um, plays into, if this is the turning point of a lot of these, the changing of the guard, so to speak, where we see a shift or a rotation out of what has dominated and into what has lagged. To your point, right, about how there's these other asset classes are so um, grossly underowned by
Yes.
individual investors, especially, but even by institutional investors and globally. Once that reallocation begins, so once there's enough time that passes where these other things do better, you'll see this, reallocation of capital from, let's say, large cap US stocks into other things. And that could itself become fuel for the fire to sustain this rotation. We don't know. We'll have to watch it and see, but that stage has been set for sure, right?
No, I agree. And the I believe it's just this month alone, the Nasdaq has shed close to $3 trillion
Mm-hmm.
worth of market capitalization. I mean, that is huge. And the total market capitalization of the small cap Russell 2000 index is less than $1 trillion. And so
Astonishing.
imagine if you see some of that rotation coming out of the big tech stocks going into the small cap US stocks, which have lagged, substantially over the last 10 to 12 years. Start to see it rotate into these international markets that have much lower market capitalizations, that those flows could really buoy, as you said, and they could add fuel to the fire. It's got to start somewhere. Nobody's going to ring the bell necessarily to tell us that, this is the turning point or it's over, but we do have some of the signs, right? We do see some of the signs when we look at the relative performance of S&P relative to international, relative to emerging markets, relative to commodities. When those are all rolling over, it lets us know that maybe the sustained outperformance from the U.S. market that we've become accustomed to for the last 10 to 15 years, it may very well be behind us for a while.
Yep. Well, so I guess we'll wrap it up there. I guess a final thought that I'll throw out, and then maybe leave it to you for one, is encouragement to everybody watching not to get caught up in the headline news and the emotions that can be stirred on by watching the markets on a daily basis or listening to the headline news flow and letting that affect things, but rather follow process, follow trend, and adjust accordingly. I'll leave it there for me.
I think that's great. And the other part is, don't allow the narrative to influence you not to have exposure to something that is working. So many investors this year and post the election have not wanted to have exposure to the international and emerging markets because of these threats of tariffs. And they're the best performing asset classes so far year to date. They're firmly higher this year. That's not the case for the US markets. And I just want to encourage people to try to mute the noise. Don't let that narrative scare you away from having that necessary diversification in your portfolio. And also remember, we're not investing in the markets that are in the rear view mirror. We're investing in the markets that are in front of us. So make sure your portfolio is adaptable and that you're positioned for the world that we're moving into and not the one that we're leaving behind. So thanks everybody again for joining us today. Chad, appreciate you hopping on here. Hope everybody has a great weekend, and we will see you next time.